Happy Friday, everyone. Last week in the written portion of the commentary, Dave shared a couple of tips on financial planning. This week, we're going to expand that conversation and start looking toward what we can do for year end. It's hard to believe it's already August.
Yeah, it's
I
crazy.
know for you and I, that means starting to look towards some of the year-end planning tools that we can utilize with clients from both a tax planning standpoint and a charitable contribution standpoint.
Yep.
We're gonna hit a couple of those items today, but I know in the written commentary last week, you talked a lot about QCDs. So just a quick synopsis, not only what is that, but what were you talking about that clients could utilize?
Yeah, so a qualified charitable distribution, a QCD, is a gifting strategy that you can effectively do your gifting to a 501c3, not to another family member, but to a 501c3 directly out of your IRA once you reach age 70 and a half. So a little bit of confusion. It used to be at RMD age, which used to be 70 and a half.
Yes.
But those rules have changed to age 72 when you're mandated to take money out your RMD age. But you can still do a qualified charitable distribution at age 70 and a half. And that's a wonderful way. So anything that you send over as in the form of a QCD from your IRA or 401k to a 501c3, you don't get taxed on those dollars.
So what you're basically saying is if someone is charitably inclined, as opposed to just looking, as we all do around the holiday season, just gifting cash or maybe out of a brokerage account or something along those lines, that actually if someone is over age 70 and a half, it may be probably more beneficial to gift directly from their IRA.
Absolutely. And there's a saying that we're going to say never give cash, never gift cash if it's going to a charitable organization. There's a ton of strategies, highly appreciated stock, QCDs, and we'll do videos and put out content on those strategies later. But just never gift cash unless it's to a family member. There's probably more tax efficient strategies, and that's one of those.
100%.
Yeah.
Another tool that I know we start looking at this time of year, and for some of you, this is a kind of planning technique we've used in the past. For others, it may be something that we start talking about because of the market cycle that we're in, is Roth conversions. So a Roth conversion is pretty straightforward. We're just taking dollars from the pre-tax IRA, or you can even do this within your 401k plan. We're converting those dollars, paying taxes now, and moving the proceeds to a Roth so that they can grow tax-free and be taken out down the road if you hold them for long enough, tax-free as well.
Absolutely.
One of the reasons that we think this year may be even more advantageous for certain individuals, because this is not a one-size-fits-all thing. This is something where obviously we're consulting with your CPA as well. But one of the reasons this year may be even more advantageous is we've obviously had some market volatility. And when the market is disconnected, that just means there's more shares that we can then go convert into a Roth, so that hopefully, as markets are efficient and go up long term, those shares that we got in to now what will be a tax-free vehicle coming out can appreciate, and we can take advantage of those tax savings.
Absolutely. And then a third thing we're going to talk about today is taking, when you do hit your required minimum distribution age,
which is
72 at this point,
72,
and it may get pushed out farther. We'll see what legislation comes up. But as of right now, it's age 72. So another idea is if you do not want to gift your required minimum distributions each year, you want to keep those. Rather than selling something inside your pre-tax account and then moving the dollars into, let's call it a brokerage account or your savings account or checking account, if you take shares that equal the required minimum distribution amount and move those what we call in kind, so you're literally picking those shares up on a pre-tax basis, shifting them into a brokerage account, it does create a taxable event. So ideally, maybe if there's a tax bill that you need to pay, maybe you pay it out of another resource, a checking or a savings account that you have. But by nature, by taking those depressed share prices, to your point, at the current market rate, you're getting more shares to equal that required minimum distribution amount. Once you put those into the taxable brokerage account, all future growth on those dollars, you're not just maintaining adequate market exposure and selling out of positions, so you're fully invested, but you're taking it from an ordinary income, where if you take money out of a pre-tax account, it's ordinary income, and you're putting it into a more friendly tax rate environment. So we're looking at long-term capital gains, which is either 0, 15, or 20% with current tax law, versus folks that are, if somebody's at a 20% long-term capital gains rate, they could be upwards of what, a 37%,
Absolutely.
32% tax rate. So it's a much friendlier tax rate environment as well.
As you've seen in the past, we're always looking at year end as a time to not only talk about charitable contributions, Roth conversions, RMDs, but especially in a year like this year when markets are disconnected, there's always things you can do through volatility.
Yep.
And that's one of the silver linings about years like this year. When markets are down, there are still tools that we can utilize from a tax planning standpoint to get clients positioned in the right way as markets turn back the right
Taking
direction.
lemons and making lemonade.
Absolutely. So we'll always qualify this with, these are not generalized, everyone should do all of these things. As you well know, talk to us. Each of you reach out to your advisor to talk about whether any of these strategies would be appropriate for you. So thanks for joining us this week and have a great weekend.